Well, good morning, everybody, and good afternoon to the East Coast people on the call. Welcome to the Outlook 2026 for AlphaCore. I'm Dick Pfister, the founder and CEO of AlphaCore. And before we get started, I just want to run through a couple of logistics. We're going to go through the 6 top questions that we have in 2026. But if you have questions along the way, please feel free to ask questions using the Q&A button in the software itself. And we'll try to cover those as we go through the webinar as well. And so please feel free, if there's a slide that we're going through, if there's a statement that we've made, we want you to contribute and ask questions throughout the next 45 minutes or so. In addition, we're going to be reviewing our Outlook, which is actually available on alphacore.com. If you go to the Insights page, you'll be able to get the full commentary written by our research team. So we're going to review some of the charts and comments in that commentary throughout this 45 minutes. But if you miss something or you want to forward it to a friend, please go to our website, alphacore.com, and forward it on. So I'm going to jump to a couple of slides here. And before we go there, I want to make sure I do a proper introduction. So they say that you're supposed to surround yourself with people that are smarter than you. And I would definitely say that I have done that today. And the 2 people on either side of me are the brains behind our research team. And I'm going to give them a little bit of an intro here, but I really won't do it justice because they have so much, many years of decades of experience in the world of investments. First, I'll introduce our Chief Investment Officer, Eric Gerster. He has been involved deeply with our team. He leads our investment strategy, our portfolio construction, our risk management across the firm. He's been with us for 4+ years, but has been in the industry for 30 years plus. He used to run long-short funds for Millennium. He ran long-short for Point72. He also started his career at T. Rowe Price, and it is really just an honor to have Eric on our team to help lead the research efforts at AlphaCore. And for those of you who are clients of us, you could know that you've been able to reach out directly and speak to Eric and the research team at AlphaCore. To my right, I've got another incredible talent, and it's Dr. David Stubbs. David joined us about 9 months ago from Blackstone, who was he was a chief economist at Blackstone, was a favorite speaker at our AlphaCore Wealth Summit that we host every September. And we had an opportunity to bring David on our team about 9 months ago. We took that opportunity and ran with it. It was really a blessing to have David on the team. He runs provides macroeconomic insight. You might have seen him on Bloomberg or CNBC. He's a regular on Fox Business as well. We're really excited. I'm excited to have both of these team members on to talk markets for 2026. And there's definitely no shortage of topics we'll be able to cover. So let me jump right into it. Maybe what we want to do is a recap of 2025, and then we'll go into some Q&A for 2026.
Thanks, Dick. Thanks for that kind introduction. I want to wish all of our clients and participants today a happy new year. We wish you all the best for you and your families in 2026. But I think before we talk about the 6 questions for 26, we'd be remiss if we didn't spend a minute to look at what a really spectacular year, again, it was for markets in 2025. And that was headlined with a lot of volatility. It was a real roller coaster. We at one point were down almost 20% on the S&P 500 back when we saw the Liberation Day tariff announcements in April. And then with a quick reversal by the administration, we saw a rally, and that continued through the year, really underpinned by strong economic growth and strong earnings growth by U.S. corporates. So the S&P finished up almost 18%, but it was outdone with the best year in international stocks in a decade. International markets finished up over 32% last year. So those are really some robust numbers, but they were outdone by gold. Gold was something that we brought into our portfolios for many clients a couple of years ago. We'll talk more later about how we feel about gold today and why we think it's still an appropriate allocation for many of our clients. It was up over 60% last year. That might lead some people, we get asked a lot when we talk about gold, about cryptocurrencies and was that someplace that you wanted to be last year? It sure looked like it post the election of President Trump and the change in administration, because it was much more favorable toward cryptocurrencies, a change in the regulatory environment. And yet we sat there at the end of 25 and Bitcoin and other cryptos were down. Bitcoin was down 6% last year. Bonds had a great year, their best year since 2020. And we saw steady, consistent, high single-digit, low double-digit growth in many of the alternative asset classes that we like to invest in.
Yeah, and I think that's what makes that such an extraordinary year is that the contribution across the piece, right? Equities, risk asset, bonds had a good year, extraordinary times, in gold as well. It's not usually like it's supposed to be like that, right? You're supposed to have, there's supposed to be different forces driving different asset classes. This kind of everything rally is not going to happen every year, but I think that's extraordinary to reflect on the forces that drove that.
Yeah, and I think what's nice about how we're going to run this presentation and Q&A is we've gotten from our clients, from people we talk to in the economy, these are typically the top 6 questions we're getting from our clientele and from the institutional allocators we talk to. I think number one is how long before the AI boom runs out of steam. That's something we want to cover. We've got some slides to talk about it. So why don't we jump right into that?
Great. Yeah, I mean, I think if we think about AI, what most people think about is NVIDIA and the hyperscalers. So the largest hyperscalers are Meta, Microsoft, Alphabet, Amazon. Let me just quickly, what is a hyperscaler? So it's a business that lets companies focus on their business while the platform or data center handles growth, reliability, and scale. So basically what it means is a company doesn't have to own their own infrastructure. They pay only for what they use, and it allows them to grow rapidly and handle spikes. And so the largest 4 companies that do this are Meta or Facebook, Microsoft, Alphabet, and Amazon. They are going to spend roughly $400 billion, just those 4 companies, in 2025, and are projected to spend $550 billion in 2026. So obviously robust growth again. They're generating tremendous cash flow to support this. So we believe AI continues to grow in 2026 and really beyond. But there are different ways to play this. David, what are some ways that we think is interesting to play it that you don't just have to buy NVIDIA or Microsoft?
Yeah, absolutely. I think that the energy requirements are going to be phenomenal for AI, and we've been leaning into playing that most clearly through a private infrastructure strategy. And I think that's one of the interesting things about the different themes right now. It's not hard to get exposure to these hyperscalers, right? You just buy the S&P 500. They're a huge component of it, but energy is less than 3% of the S&P, and I think that's why it makes it an interesting theme for us, because you do have to think carefully how you're going to get exposure to this, and that's obviously something we think very deeply about. And when we look forward, Eric, you just obviously discussed the projections there. Still, despite all this investment, there's still very little spare capacity in data centers. There's a real crunch on energy, and so that combined kind of investment nexus, energy, data centers, and all the associated industries, it just looks to us that this is going to roll on for the next couple of years. Whether everyone ends up making money on those investments, because there's no doubt that AI is going to be transformational. The question is it going to be profitable? It's very profitable for NVIDIA right now. We know that.
Right. Sure.
Is it profitable for the people who are actually marketing the services to you, me, and businesses, and AlphaCore and everyone else? That's a question mark. You start to see markets late last year differentiate, which is usually a good thing, so markets should be doing, about those companies that have that profitability. So while there's some questions there, I don't think there's much of a question that the capex expenditure is going to be a powerful driver the next few years.
So one of the questions I get a lot from our clients are, is this reminiscent of the late 90s, or what makes it different than the late 90s and the dot-com boom and bust that happened in the early 2000s?
Well, I think one of the biggest differences, having invested in technology in the late 90s, many of those companies didn't even have real business models. Companies traded on how many clicks they got. There were companies like pets.com, which didn't actually really sell anything yet and went public. The companies that are public today have real business models. And as you can see in this chart, they're generating substantial cash flow. They're not taking on debt specifically to fund this. There's certainly some companies using debt as a way to finance part of this, but they have cash flow to support it. So these are real businesses, real companies. Will there be some overinvestment? No question. When you have this amount of investment this quickly, there are undoubtedly going to be areas of overinvestment. But as David pointed out, right now we're still capacity constrained. There's not enough data center capacity to handle the needs of artificial intelligence growth. Microsoft, Meta, Amazon, Alphabet, they're all saying that every single quarter.
Yeah, the financial markets are supposed to anticipate and price stuff in. And there's no doubt that a lot of the benefits to these companies have maybe been brought forward. We've seen some optimism. Right. You can make a case that going forward, maybe the returns might not be as spectacular next 5 years as the last 5 years. A lot of people are saying that online right now, but it doesn't mean that we're seeing something that's totally out of whack with the needs of this incredible transformational technology and everything they could bring to the US economy.
In other words, they can grow into the astronomical PE ratios that they have right now, like Amazon eventually did.
Yeah, and well, what's actually interesting is if you look at NVIDIA, for example, it's actually cheaper on price earnings now than it was 2 years ago.
Yeah, sure.
Because it did grow into that. And if you look at the top companies, they are growing earnings faster than the market on average. So yes, the market is somewhat expensive here, but it's also for many of the companies justified by the growth that they've shown. I think the other interesting thing about last year, though, is we saw the market start to broaden out in the fourth quarter, and that's something that we believe should continue into 2026. And we'll talk more about the economic outlook and whatnot.
Well, that brings up the next slide here, because I think it seems fairly rosy when you think about AI and the investment in infrastructure, but the labor and productivity and unemployment rates are maybe telling a different story. So can you walk us through a little bit of this in the next few slides as well?
Yeah, I think that you always see a lot of cross currents in the economy, and we do have a somewhat confusing set of circumstances. If you're looking at overall growth in the economy, say GDP, if you're looking at the corporate profits of the larger companies that are listed, you think everything was fantastic. And then on this chart, we're showing that productivity, which is really the long run driver of improvement in living standards and profitability, that did seem to go through an inflection point in the late 2010s. Now the series is volatile. You need to allow multiple years to get a clear picture. We get an update, I think, tomorrow on third quarter productivity as well. But I think it's fairly safe ground to say that productivity has picked up somewhat, is in the high 1%, it's close to 2% now. And that is a fantastic tailwind in the medium term for the US economy. And let's be clear that a lot of economies around the world can't say that, right?
True.
A lot of developed economies would love to have that type of productivity growth. And that is underpinning, I think, what we've seen the success of corporate America. At the same time, the labor market has, I think, been through a period of normalization in the last few years. Mm-hmm. You see, obviously, that on this chart, the huge spike up in COVID, and then how low unemployment got again in 2021 and 22. Business owners on the line will remember how hard it was to find anyone. Anyone doing any work on their house will remember how hard it was to find anyone. Now we've seen that unemployment rise. You see the latest tick up there, 4.6%. And we still, however, are asking the question, like, is there something worse going on? We know there are parts of the economy that have been struggling. Small business have been saying that they're struggling. Right. The housing industry has been in the doldrums somewhat. We know that we've seen significant changes to immigration and tariff policy that have complicated certain business models for parts of corporate America. It's not crazy to think that there's a little bit more distress under the surface if you're not related to AI right now. And it's that kind of tale of two economies that that absolutely puts the Fed and other policymakers and investors in a little bit of a bind. You want to be lean in to the impressive growth, the technological change, the things that drive America forward. But you're conscious that there's a lot of people, a lot of businesses that are not feeling too great right now, and that is leads to that kind of that split.
What about the thought that AI is great? It's going to give us more productivity, but in turn, we're going to have less jobs because there's less employment needed. So is there any validity to that, or is it going to generate jobs just in different sectors? What are your thoughts on that?
Yeah, I think briefly, there's a lot of validity for that. We've seen that throughout the course of human history, where technology improves productivity, allows you to do more with less. Sometimes that's less natural resources, less energy. Sometimes it's less people, less man and woman hours. And there's certainly some very concrete evidence that AI is starting to reduce the demand for entry-level workers in white-collar jobs, which also makes it very different from previous levels and waves of technological change. It's usually been about automating blue-collar jobs. So I go into a car factory today, a lot less people than there were 30 years ago, right? So the potential of AI to bring productivity to white collar industries is enormous. There's going to be an adjustment. Now, we don't know if AI is going to be so profound that this leads to at least a few years, maybe even an era of elevated unemployment, or if this is going to be gradual enough that there's an absorption elsewhere.
Sure.
I will know that the record is 100% of the time in previous technological waves, with a little bit of a lag, other jobs have been created. The vast majority of jobs, even the categories of jobs that existed today, didn't exist, in between the First and Second World Wars when they started creating statistics around this type of stuff. So who knows what our grandkids are going to be doing, 50, 60, 70 years from now, probably very different things to what we're doing.
Right.
But that is that concern today, and that's going to place policymakers in an interesting spot and could drive some of the concern we see, and some that's been reflected in a political dialogue, not just here but around the world.
Yeah. I mean, this particular slide, and then we'll jump into the next slide, which talks about the debt. The Fed's in an interesting place because they're looking for stability in the dollar. They're in a interest rate declining mode right now. They've lowered rates already. I guess we're in a phase where they potentially are going to be lowering again this year. What are our thoughts on that, and how it reflects with regard to our debt, which has grown and ballooned?
Sure.
Any thoughts on that?
Yeah, David, I think the question here too is, you and I have talked about this a lot. You talk about the debt and whatnot. When will people care? Will they care? Will they care this year? Right? I mean, I think that's the question. And what does it mean if they care? And are there places in the world where they are starting to care?
Sure. Let's cover that, and then obviously we'd love to get some thoughts from you on fixed income in our portfolios. The straight answer: are they going to care this year? No, they're not. It's highly unlikely for this to be a major driver of severe market moves in 2026. However, over the medium term, are we planning for a world where markets start to price this in? I think you have to. And around the world, I think you've started to see that, especially in countries like Japan, in countries like France, and in countries like the UK. We have this this chart here. This, folks, is not a meme stock, right? This is not some tiny little technology company. This is the 10-year yield of the Japanese government, one of the largest bond markets in the world. And you see that significant rise there. Now, there are some healthy reasons for this. A return to modest inflation, a domestic economy that warrants slightly higher interest rates after years of stagnation. And there are some concerning elements to it as well, i.e. the very, very large debt load on the Japanese government. So I think one thing that happened last year is we did see bond markets start to price in some concern to those three major economies: Japan, the UK, and France. Different situations, don't have time to go into the details now, but the big similarity is a lot of debt, questions over the capability to service that debt. So as bad as the fiscal situation looks in the US, it looks worse elsewhere, and the markets are more immediately concerned around that. So I don't think this is going to be the year of major moves, but still, the nature of bond investing, Eric, has changed quite a lot. And I think that underpins our positioning in portfolios today.
Yeah, no question about it. So a couple of things. Within fixed income itself, we look at that and we say, do we want to have longer duration? In other words, do we want to own bonds 10, 15, 20 years? And we have a definitive no to that. And the reason is we still don't feel like there's enough yield being paid in those longer bonds to justify that. We also live in a world right now where credit spreads, which is the amount of extra premium you get paid to own any debt that isn't the US Treasury, are very tight. In other words, you're not being paid a lot of premium for that. So what that leads us to do as a research team is to do our diligence to find the people that we think, the managers that we think can find the best credits out there that allow them to take the right risks to earn the highest return for the risk that they're taking. Again, it's not just about total return, it's about how much risk do you have to take to get that dollar of return. And we spend a lot of time, we've done over 640 due diligence meetings in the last 12 months in our research team across all of our managers to find and source the best ideas, not just in credit, but everywhere. So that is one thing that's important. And, David, maybe talk a little bit about another area that we think about when we think about the debt, which is gold. And how do we think about gold today? Do we still like it? And if so, why?
Yeah, I think that there are clearly investors out there that are alarmed by the general direction of travel around debt, potentially resurgence inflation, potentially, obviously, most people online are in the United States, a decline in the US dollar, protecting yourself against that. And therefore, and gold ticks a lot of those boxes. Historically, it's been seen as a hard money anchor when things like demonetization and inflation are present. The bigger thing that's going on, of course, is around the world there is a fragmentation of international finance. There is a fragmentation in geopolitically, where very, very large pools of capital want to reduce their reliance on the US dollar, at least for the core of their financial reserves. Many of these countries simultaneously have large pools of money investing in the equity of America, but when it comes to their central bank reserves, when it comes to the things that underpin their banking system, they're less willing today to have a lot of US debt, and you could say European debt as well. What they want is gold, and they want it in their reserves sitting in their country. So we've seen massive waves of central bank buying of gold.
What was there a political event that might have helped trigger increased central bank purchases?
I think there was obviously Russia's invasion of Ukraine was, I think, the most powerful catalyst. But I would argue that really over the last 10 years, when you've seen the world move towards arguably the early stages of great power conflict between the United States and China, when you've seen less willingness of the US to lean in to a rules-based order through the first presidency of the current president, and now in this one as well, you've seen a move away from the kind of unipolar moment where we were all happy to own each other's debt. And I think that the realization on the other side as well is that, hey, we've obviously let China into the WTO. Has that gone well for us? Can we have this highly trusting relationship on both sides? I think the answer is no now. And so the central bank buying of gold has been enormous. Even through official channels, there's probably a lot of unofficial buying going on as well. It's hard to track. So some of this bars moving around from one vault to another, in London and Switzerland. But underpinning that, gold remains a great proxy for some of the things you might want to protect yourself around: inflation, de-dollarization, banking turmoil, war, geopolitical tension. There's a lot of that floating around the headlines right now. I don't see any time soon that we're going to step away from gold.
So just to reiterate, if you have questions, just type them into either the Q&A or the chat. There's a couple that have come through, and I think they're related to these slides. So the first one I'll ask is, yes, last year in 2025, international markets did very well, better than the US. How much of that outperformance was due to the dollar devaluation? And do you expect it to continue in 2026?
Yeah, it turns out there was a point in the year when almost half of the return from international markets was from a weaker dollar. But the dollar strengthened as we went towards the end of the year, and we saw markets improve valuation internationally. So it turned out at the end of the year, it was only out of the 32%, I believe it's about 6% of the 32% came from, so it'd be 20% of the total.
It depends on your definition of international.
There's
we actually got a slide in a couple of slides on this. The big winner, obviously, currency-wise, was the euro. Went up a lot. Some other ones like the Chinese economy, Chinese currency didn't. So here you see it there. International on the right, emerging markets. That kind of green band shows very little there. In EFA, which is Europe, Australia, and the Far East, a big contribution there from currency. So that was a significant one. We're not banging the table that that the dollar is going to go down and down and down over the next couple of years. But I think it's one of the obvious medium-term trends that could establish itself. And when we see a lot of portfolios, people joining AlphaCore, and they're 100% US, it's like, we love the US as well. It's obviously going to be the core of your portfolio, but there are tremendous opportunities offshore. And that is the most kind of proactive way to control the risk that maybe the dollar, which has come a long way, is quite expensive, does leak at least some of its value over the next 3 to 5 years. Great way to do that is to lean into some of these international investments, and we at AlphaCore believe that international investing is part of the right setup for most people.
I'll ask one more question. Just came through, and we get this question a lot, given what happened in the last couple of years with precious metals. We talked a little bit about gold, and gold had a tremendous year in 2025. Silver was even a better performer, up 140% plus. So the general question then becomes, what percent of my portfolio should I have in gold and silver and precious metals? So how would you guys answer that, generally speaking?
I think it's hard to give a stock answer because it's going to be a little bit different for every single investor and what their risk tolerance is and so on and so forth. You know, when we think about it, it's typically going to be something in the low to mid single digits,
Right.
As a percentage of your portfolio. It's something that offers you, you know, the ability to have some downside protection when gold or other precious metals provide that, and at the same time, it's large enough that you can get some upside. It's actually interesting. It depends on when you want to have your cutoff, but sometime in the last quarter or so, we saw a period where if we look back 20 years, gold had outperformed the S&P 500.
That's right.
And when I saw that, that was sort of shocking to me because there was a period where gold did nothing for a long period of time. Even when inflation spiked, it didn't do really anything that year. And it was always thought of as an inflation hedge, and it didn't prove that. And we've actually done this study. As you'll remember, we wrote a note on it a few years ago that it has not always been a great inflation hedge. But there's a lot of other reasons, as David talked about, why we like it today.
Yeah, exactly. So I think that we would say a modest allocation for gold is really a high conviction baseline for us. Then there are certain clients, and obviously the one who maybe asked the question, that wants to engage with these other metals. It's not just obviously silver. There's palladium. There's many others. There's a broader then conversation around more kind of industrially focused metals. Copper has had a very strong year for example, and we are considering ways that there, and again for clients that want to play this, we have ways to play it. We know that there's a lot of clients that maybe aren't as focused on this space.
Yeah, I think what this leads to is we're in a year now where there's going to be midterms. There's been questions that just came through. I'll ask a few as we go through, but let's talk a little bit about second year of presidency of a four-year term. Can we talk a little bit about history and maybe look at what potentially happens in 2026?
Let me start off with this chart, and I know Eric's got some comments on it. So the kind of game plan around this chart, as it were, what it speaks to is that both the mean and median returns by presidential year, they're by far the weakest in the second year, which is the midterm year. Right? That's what we're stepping into right now. I think that makes some logical sense. Right, the new president comes in, is able to address issues, has full of political capital, especially if they have control of both houses. That's again exactly what was the situation in 2025. Yes, it causes a lot of volatility, a lot of uncertainty as well. But you can see that the market responds to strong leadership, knows who's control, knows the agenda. Right now, we move towards midterms, and the usual pattern is that the first half of the year there's no real effect. But as you start to get a few months before the midterms, the focus of the market turns there. Volatility starts to increase. And often it can get pretty choppy. Then the pattern is after the midterms, there's usually some type of relief in markets where they know who they're dealing with. It doesn't matter who's winning, they know what they're dealing with. So that's what leads to average returns which are lower than the other 4 years on average. Now these averages mask great volatility, folks. We're not going to make investment decisions based on this, but it's a good gut check just to let everyone know what we might be moving into there. And also say that when you're investing in equities, you really want to have a multi-year time horizon anyway. If you can't take a little bit of volatility around election cycles, then equities are not the right asset class for you. But I think overall, it wouldn't be surprise us is in those months leading up to the November elections, if markets start to show some concern there, and we're certainly prepared for that.
Yeah, I think that there's also some reasons that you should be very optimistic about what could happen in 2026. Forecasters are projecting 15% earnings growth for the S&P 500. That's an incredibly strong number. We have a large amount of tax refunds that will be coming early in the year because of the tax bill that passed last year. There's some corporate CapEx reasons why CapEx should really accelerate this year, because companies can accelerate depreciation, meaning they get more cash flow now because they pay less taxes now. So there's some positives there. And then as I get towards the end of the year, markets are always forward looking, right? When there's more volatility, uncertainty, like in April, that forward window shrinks. When there's less uncertainty, that forward window widens. So one of the things that we'll really be looking for as a team this year, we talked about AI, how strong it's going to be in 26. markets, as we get towards the second half of the year, will say, well, what about 27? And that's something that we're going to look at, because there's no question AI is driving a lot of overall sentiment and whatnot in public markets. And so we'll be looking at that as we go through the year. In addition, obviously, we do watch geopolitics, but generally speaking, over the long term, they don't have that great of an impact on market returns.
Yeah, absolutely.
I'll ask a related question that comes up very frequently, given the market run we've had over the last 5 years, and 2025 is no exception. There has been a lot of embedded capital gains in our clients' holdings. So concentrated, incredible returns, and the likes of the names we were talking about: NVIDIA, Amazon, Google, Apple. And we have some clients who would like to diversify, but they don't want to pay the capital gains tax on those particular holdings. Are there any solutions, like broadly speaking, that we can help them with to help diversify from these concentrated positions that they've done tremendously well on, but like to now maybe diversify into international or other asset classes or alternative strategies? Anything we can suggest, broadly speaking?
Yeah, Dick, I think the great news is there's more solutions there than ever. That new ones have come along the way in the last couple of years. And there are different solutions that are the right fit for different clients. We work with clients in these situations all the time, whether they, I've worked in the technology sector, and maybe for one of the most leading companies like an NVIDIA or Amazon or Microsoft, and we can help them. And, that's a great conversation for those clients to have with their advisor, where they can bring the research team in, and we can certainly talk to them about that and help them in that. But, as I say, that it's a great way to diversify your portfolio and continue to defer those gains, because at the end of the day, that's what you're doing. You're deferring the gains. You're not avoiding the gains, but have a more diversified portfolio and reduce what we call idiosyncratic risk, or the risk that one stock or 2 or 3 stocks can drive your total return.
Right. And I bring it up because we're early in the year in 2026, and to take full advantage of that, to have a 12-month, have the full calendar year is important, to start doing that earlier rather than later.
No question.
The other thing, of course, is you can borrow against the holdings, right? There's many different ways to do that. That's part of the conversation to have with the wealth advisor, because there are different mechanisms there. But the Fed rates have already come down below 4%, plus a small spread on top of that. We think that's probably going to shift lower. The markets are pricing in expectations for 2 further cuts. So the lower that gets, the more the better the economics of borrowing against your holdings, and even modestly can really improve the diversification and boost total returns.
That's right. And I guess we should ask, another question came through. Do we expect the Fed to lower rates, and what's kind of the range of expectations we have at AlphaCore about what the Fed's going to do?
Yeah, well, I think so. Firstly, what expectations are priced into markets for around about 2 25 basis point cuts, right? So that's the Fed cutting by another 0.5% to get into the low 3% for their policy rate. That's what markets are pricing into. Now, this is really a game of what happens with the labor market. As we discussed, the unemployment rate has been drifting up. Concerns over the labor market have really been the main driver. There are others, but the main driver of the 3 interest rate cuts we've had this year, and indeed the 1.75% reduction we've had since the middle of 2024. And this is one continuous process. So let's remember where we were 18 months ago. The rates were at 5.5%, and you were getting a fantastic yield on your money market fund that's now a little less fantastic, right? So so that's, I think, this is a game of, you tell me what's going to happen with the unemployment rate, I'll tell you what the Fed's going to do. So broad stability in unemployment rate I think is probably behind two cuts. But to be clear, if unemployment keeps ticking up, we get another number this Friday. If unemployment keeps ticking up, this is a central bank that has an explicit full employment mandate, and it's not crazy at all to think that they could cut once in each quarter and bring the rates down by a full percent this year. So that'd be roughly 2.75. And last thing, of course, is we're going to get a new chairman of the Federal Reserve. I believe in May. Lots of speculation over who that's going to be. Lots of speculation about how that person's going to act. And markets simply just don't know at that point, right? So it's one thing to understand what they call the response function of this Fed, this chairman, to the economic conditions. And I think that Jerome Powell would like to not cut much more because he thinks he's done quite enough already. But unemployment goes up, and he might well. It's a total another game to work out who's going to be in charge and how they're going to react in the second half of the year. But I think pretty highly likely that rates will be a little lower by this time next year. And that's a very supportive environment for markets and supportive environment for strategies like, say, taking out their.
Sure.
So, David, you talked about the Fed having the dual mandate, which of course they do, and you talked about the labor side of it. Of course, the other part of their mandate is inflation.
Yeah.
And they're supposed to have a stable pricing environment, which, for better or worse, they defined in the 2010s as 2%. We can debate why, since that's not in the mandate.
Sure.
They're not at 2%, but it's actually been stable if you look at the inflation for about 18 months now. So how do we think about inflation as it factors into that and the labor and this dual mandate?
Yeah, well, especially as you said, there's nothing magic about 2%. It just became the international standard. And there's some reasons behind that. Markets and economies tend to be reasonably healthy if you have positive but low inflation, right? So that's why most central banks target something around that. You're right, Eric. It's come all the way down from mid-single digits or high single digits, depending on which measure, to bouncing around 3%. It's a little high for their target for sure, but they're fairly comfortable there. And they certainly proved themselves comfortable enough to cut interest rates and support the economy whilst inflation's been up there. Now, of course, some people are howling about this, saying, "Oh my God, right? Inflation has actually averaged 4% since in this decade." And markets are on fire, and you're cutting interest rates. What are you doing? And of course, we've lived through an incredibly uncertain pricing environment, mainly because of tariff policy. Right? No one knew what the tariffs are going to be. No one knew how much they were going to feed through. This, by the way, just very quickly, as Dick's got to this page, this is a measure, folks, of economic policy uncertainty. You can go online and find it yourself there. Now, take it with a pinch of salt. Very hard to put a number on these types of things, but they look around at all the news articles in the world and work out, how uncertain things are, and think about how elevated, the uncertainty was at the beginning of this year. By this measure, it was roughly the same as where we were in COVID. I mean, think about that for a moment. That's an extraordinary level of uncertainty. And you think about tariff policy changing, immigration policy changing, tax policy changing, international geopolitical relations being reshaped before our eyes. This was an extraordinary year. I think it's going to be somewhat of a calmer year because, again, because we moved to the midterms, the president gets a little bit constrained there domestically, and we've got through a lot of these things. Immigration policy has changed, not going to change again. We've had the One Big Beautiful Bill; they're not going to do it again, right? So a lot of this is in the rear view mirror. But on the tariff side, we didn't see that much pass through. By most measures, 90% of the tariff impact was absorbed by corporate America. We saw only a modest amount going through to inflation, but enough maybe, Eric, to your point, to push inflation up by, say, 0.5%. So it would have been closer to 2 without it, than 3. I see incredible forecasts that some of that inflation is going to come through in the first half. It's another reason why the Fed might hesitate a little bit. But the bigger picture is the president seems to have moved away from focusing on tariffs. There is now obviously concern about the affordability agenda. We're now, I think, within the next 60 days, going to get the Supreme Court decision about whether he can even use some of these powers to do these things there as well. So the tariff risk, I think, is fading somewhat. There could be lagged effects in inflation, lagged effects in business, confidence as well. But the bottom line for inflationary is that I would imagine it's going to be lower this time next year than we are today, maybe only modestly. And it doesn't need to get all the way down to 2% for the Fed to think that they have enough freedom to support the economy, and that's what they've already shown.
Well, and when we talk about this being a midterm year and the current administration very invested in retaining control of both houses and affordability being clearly foremost in the minds of American consumers, it has led the president to walk away from some tariffs. And so that obviously is not as inflationary. So we started out with everything tariffed, and now we've continued to chip away at that. And I think you'll see more of that personally as you go through this year, and affordability is top of mind for the American consumer. Can I ask too, David, there's a lot of talk about the K-shaped economy. And the difference between the top of the consumer chain and the bottom of the consumer chain. How do we think about that as a research team when we talk about that, and how does that impact what we do from an investment perspective? And maybe for our group here, what is that K-shaped economy? What does that mean?
Yeah, well, the K-shaped economy you're referring to is the divergence between high income, high net worth households and low income, low net worth households. And this recovery since COVID, where asset markets have done tremendously well, high incomes have done well, and yet cumulative inflation has really pressurized low income folks, right?
That's right.
I mean, by most measures, groceries are up more than 40%, this decade, right? And you've seen other pressures as well. The housing costs extremely high, both buying and renting, there as well. So you've seen that pressure on low income households there. Yet at the time, obviously, wealthy folks have done particularly well. There are other major divergences in the economy. Large companies seem to be doing okay. Small businesses have been saying they've been hurting for a while. Anything linked to AI is flying. We touched on other parts of the economy, housing being a great example. Other parts of construction, offices, etc. You're really struggling. So there's significant divergences there. How do we think about it? Well, obviously, if you're exposed to businesses whose customers are in the lower income, you're going to have to expect some weakness there. There are parts of the stock market there. There are parts of the credit markets there. I think this, for us, goes into a risk management focus when we look through our managers, especially things like in the private credit space. With a lot of headlines about that every day. We obviously want to be focused on high quality managers that are focusing on the stronger parts of the economy. And so I think it's a risk management exercise. But I think that the unfortunate truth in some ways is that it's the upper part of the K that drives the bus, right?
Right.
It's those consumers in the top, say 20, 30, 40% of the economy are spending the vast amount of the money they are continuing to spend. You see many businesses reshaping their business strategy to focus on that higher end consumer. Those higher end wealthy folks often have capital that is invested for the long term, leading to stickiness of capital, usually a good thing, right? They can put money to work for long periods of time and support growing and innovative businesses across not just the stock market, but across venture and private equity as well. So from an investment standpoint, you can make a case that there's some positives as well as negatives. From a societal standpoint, I don't think there's many people who would say this is a good thing. And when you see the volatility at the polls, we saw the elections in November. We see where the polls could be a difficult time for the ruling Republicans in the midterms. And around the world, folks, it's a good time to mention. Around the world, you're likely to see this as well. There are 5 state elections in Germany and local elections in the UK. Why does that matter? It matters because it's possible that the far right, who are playing off a lot of these affordability concerns, could have very strong showings in those elections. That's and right. Pre-stage the potential takeover of major European economies from these type of political parties. So this affordability agenda, affordability it's in some ways this doesn't quite have the impact it should, right? You're really talking about the fracturing the social contract. You're talking about the fracturing of the political center in many developed economies, and that's something to watch for here as angry voters throw out incumbents all over the developed world.
Yeah, and we're getting close on time, but there was one question that came up that we probably have to ask because it just happened. So why have the markets completely shrugged off the capturing of Maduro and what happened in Venezuela? Why nothing happened? There was a blip in the markets.
You want to take a shot on that, Eric?
Yeah, sure. Well, I think first of all, if you look at Venezuela in the context of U.S. corporate earnings, which is what drives ultimately stock prices in the U.S. is cash flow and earnings, it doesn't really impact U.S. corporate earnings.
That's right.
Even if you look at the energy sector, which is potentially going to benefit if they're able to make new investments in a country with large oil reserves like Venezuela, that's less than 3% of the S&P 500. So it's a very small percentage.
Right.
And I think as we talked about earlier, historically speaking, geopolitics don't have large impacts on the U.S. market. Even, you think back to when Russia invaded Ukraine, there was a very brief blip there when the U.S. market sold off. And then investors said, is this going to impact corporate earnings and cash flow? Well, we don't think so. Let's buy stocks.
Right.
And so I think that's ultimately what people come back to is, how does this impact corporate earnings? Because at the end of the day, it's cash flows and earnings that drive stock prices.
Yeah, I totally agree. The US is actually quite a closed economy, right? Something like 85 to 90% of activity is domestic. There's a lot of earnings from the S&P that's internationally typically around 40%, but those earnings, usually nothing to do with Venezuela. I think the other change in markets, you said the 3% for energy is, if you remember back in the mid 2010s, you had the shale boom, and there was some really rough times in high yield because a lot of them had issued.
2016.
Exactly. There was a kind of a real fallout there. Today, energy is only about 11% of the high yield market. So whether you're looking at bonds or equities, this type of impact is very, very low, even if there was any exposure to Venezuela, which there really isn't. And I think the other thing, Dick, is that a lot of people just shrug and think that we have a geopolitical environment today where these types of things can and will happen again.
That's right. Well, I think that's probably a good place to end. I just wanted to reiterate to everybody that's on this call or anybody that's going to listen to a recording of this, which there'll be a recording available over the next 24 hours. It is truly a pleasure and an honor to have this high caliber on our team. And so if you are talking to your advisor, your advisory team, and you'd like to set up a call with David or Eric or the research team in general, please let us know. Please reach out. They are literally 7 days a week, 24/7, monitoring and helping with asset allocation, both on the micro and the macro level. I want to thank you for spending the time with us today. Appreciate it. We'll be having future webinars over the course of the next couple of weeks.
Next one?
You'll find it on our insights page. We'll have a full calendar is on our website.
I believe that you're focusing on artificial intelligence.
So we talked a little bit about artificial intelligence today. Our next webinar will be specifically focused on the market of artificial intelligence. We'll be joined by a prominent investment firm in the enterprise software and artificial intelligence space. We'll have two speakers that are going to talk about AI, its impact on public markets, and also how it impacts us in our daily lives and how we should think about and learn about it. So look for details on that. That'll be in early February.
That's right. Well, thank you, everybody. Look forward to talking to you. And if you didn't get any questions answered that you proposed, just reach out to your advisor. We'll get it done for you. Thank you.